Welcome to College Smart Radio, helping you bring into focus the true cost of college and how to tackle the runaway cost of financing a college education. College Smart Radio is hosted by Beatrice Schultz, a certified financial planner and founder of Westface College Planning. Now, here's your host for College Smart Radio, Beatrice Schultz.
Where you store your child's college savings could impact his or her ability to attend college as much as grades and standardized test scores. Section 529 plans are often the go-to college savings vehicle defaulted to by many families and many financial advisors. Saving in a whole life insurance policy can beat a 529 plan for its features, including flexibility, low risk, financial aid invisibility, and access to your money. On today's College Smart Radio program, I have a financial expert with me on the show to help me share with you the fundamentals of how a cash value life insurance policy really works for your family. Hi, I'm Beatrice Schultz. Welcome to our weekly show, College Smart Radio, where we help you tackle the runaway costs of a college education. Our show is all about bringing up-to-date and practical advice to parents who are dealing with the costs of a college education for their kids. With a private school costing up to $60,000 a year, a UC costing close to $35,000, and a California State University running $25,000, parents need more help than ever. We bring you that help by sharing ways to pay less, tapping into financial aid, and prioritizing your source of funds to make sure you get through the most expensive years of your life. Based on my own education and experience, I share my insights with you week in and week out. I hold a bachelor's of science degree in chemical engineering and a master's degree in international business. I'm a certified financial planner and the owner of the San Carlos-based college planning business, Westface College Planning. I host workshops on college planning and consult with parents on a daily basis. In addition to my insights, I bring in experts in many areas of the college process, from counselors, financial aid professionals, financial aid officers, student coaches, parents, and even students. You'll learn firsthand the ins and outs of how to pay for college and survive financially. In addition to our show, you can find lots of powerful information at our website, www.collegesmartradio.com. We have many articles that I've authored with up-to-date information on navigating the waters of paying for the runaway cost of college. We have a monthly e-newsletter full of content about college planning. We also have posted a glossary of key terms used in the world of college planning. Terms like total cost of attendance, FAFSA, student assets, base year, and so forth. And we have a link to our free community parent workshops and webinars that I host to teach parents about how to pay for college and how the financial aid system really works. So let's get into today's show. My guest today is Mr. Don Blanton. We are fortunate to have Don on our show as he is one of the foremost experts in the country today when it comes to helping families with their financial plans. Don's been working with families for over 25 years, helping them understand the ins and outs of managing their money. In addition to helping individuals, Don is a founder and president of Moneytrax, a leading software and training company that helps financial professionals across the U.S. and Canada communicate key financial concepts with their clients. Don has taught thousands of financial professionals, including myself, how to better share their insights so that families are better prepared for their financial futures. I feel so fortunate to be able to bring Don on the show today so he can share some of his deep industry knowledge and unique power of being able to communicate complex financial concepts. Hi, Don. Welcome to College Smart Radio.
Hi. Thank you for having me.
That's great. I'm so happy to have you here. Let's get started. Don, on our show, we've shared with our listeners many topics focused on getting kids through college and surviving the experience financially. We've discussed aspects of the college planning process during the savings phase, the spending phase, and for many, the debt repayment phase. What I'd like to get your expertise on today is the use of cash value life insurance as one of the financial tools to be considered during all three phases of the process. Given your experience and expertise in the area of life insurance, can you share with our audience the fundamentals of how a cash value life insurance policy works?
Well, sure. It's pretty simple, although it is misunderstood pretty readily. But you make contributions to the policy, and the policy grows and builds cash values. And at some point, when you've accumulated enough cash value, you have access to borrow against it. A lot of people are under the misconception that when you borrow, you're borrowing from the policy, which is not true. You're actually collateralizing a loan with the insurance carrier. And as you pay that back, the lien against your policy is reduced. The key here is that although you might have a loan against your cash value, the cash value you have in your contract is still compounding interest and growing all the while you have borrowed funds. And the reason it's called borrowed funds is a great advantage because of the tax liability. As you know, there's no tax consequences on borrowed funds. So relatively simple, but sometimes misunderstood because of that factor of people thinking they're borrowing from the contract as opposed to borrowing against the contract.
We use those terms like contract or policy, and I think people think often about life insurance as being kind of term life insurance. And really, it is a savings vehicle kind of beyond so much more than what a term policy is. And when people ask you that question, kind of how do you answer it or explain to them what it really means? Because what we haven't talked about is the fact that there's also a death benefit on top of this.
Correct. Well, most people do understand that life insurance does have death protection. And when it comes to college planning, certainly when I was sending my kids to college, that was a great benefit to have in place, that in the event that something happened to me while I was accumulating my assets to make sure I had enough money for them to go to college, if something happened to me, then that was automatically covered. No other product will do that. No other savings vehicle will do that. So insurance, the death benefit of a life insurance contract, plays a major role. But in addition, there's the capability of accumulating cash. Now, you know, in the world of finance, everyone's out there trying to find the best investments that pay the highest rates of return. And sometimes when they look at a life insurance contract and the cash value of accumulation in there, it may not be able to compete at some of those higher levels. But don't make a mistake with that, because access to capital throughout your entire life, especially when it comes to college planning, is a key component. So when you're communicating with your clients and our listeners, certainly there's more they need to know about a life insurance product. And we like to talk about that from the standpoint of a maximum efficient contract. The federal government has regulated the maximum amount of contributions, which is the premium, how much you can put in a life insurance contract. They've regulated that to keep it from being an investment vehicle. Well, we call it a maximum efficient contract because you can go up to that level, and as long as you don't go over, you still have access to that cash value, your contributions, on a tax-favored basis. So that's a very, very powerful thing when it comes to access to capital for sending your kids to college.
And part of that access to capital, or when we think about sort of the saving the money along the way, and families think about, well, I've got to save my money for, put it together. Sorry, when you talked about rate of return even and saving money over a certain period of time, well, what I've seen with so many of my clients is they've been saving that money or putting that money aside for 20 years, 18 years, hoping it'd be available when their kids went to college, and now they've got that shocking feeling of, no, it's not that some of them have even lost their money, but none of them have gotten the types of returns that they expected 18 years ago when they were starting to save their money. And that's what it's not really an investment vehicle. It's not about the rate of return, but there is a guarantee that you're not likely to lose the money that you put in.
Correct, which is a big issue. You know, when it comes to college planning especially, and certainly retirement planning, one of the things that makes people go down the road of taking too much risk, meaning more risk than they can actually afford, is their lack of putting away enough money, being in the right place where they're doing the right things early enough. So if you're behind the eight ball a little bit, what happens is you want to step out there and take higher risk to earn higher returns, which obviously, when it comes to college planning, by the time your kids get to college, you know, compound interest is been called before the eighth wonder of the world, but it takes time. And unfortunately, what happens, even over a 15-year period, compound interest doesn't have a lot of time to work there. So even though they're going for a higher interest rate in return, oftentimes they're taking more risk than they have to, and sometimes they slip off in that deep end where they've taken too much risk. The accounts that they're investing in are not paying the returns, and like you said, they could even end up losing money, which can be very devastating at the time of when it's time to send your kids to college. That can throw you back a ways.
It can be what I'm finding with a lot of my clients today is it's not even so much about what return can I get, but can I make sure that I have this available when I need to spend it? College, unlike retirement, you can't just work another year. That child's ready to go the year that they're going to go to. People worry about how much money they're going to save, and they worry about whether insurance companies, that the insurance company is going to have the stability to last for the decades that they might be saving money for their college and then ultimately for their retirement. Can you talk a little bit about the stability of the insurance companies that we'd want to work with these maximum efficient contracts?
Well, sure. Most people don't understand that a life insurance company is stronger than most banks because of the regulations that the federal government places on the insurance companies to not only protect the cash that's in these accounts, but they have a liability, which is the death protection. So to keep that enforced, there's pretty much, insurance carriers going to have to put up a lot of resources to back that money, whereas banks don't have that same issue. One of the things that is most important, I think, that people miss in this arena is the security and the freedom that comes that from day one you have access to this capital. We have money in lots of places. A lot of people have money in their qualified accounts. Again, no access to that capital during college years. Might have it in real estate. And if you get caught in a situation like we're in today, there's no real access to the money you had or used to have in real estate. Unfortunately, that's gone or at least locked up.
Absolutely. And Don, that's a big thing that we see with a lot of our clients here in the Bay Area, where they've got so much of their money in real estate and they don't have access to it. They thought they'd have access to it when it came to college. Let's just take a quick break here. You're with us on College Smart Radio on 1220 KDOW, where my guest today is Don Blanton, the founder and president of Moneytrax, a leading software and training company to help financial planners communicate key financial concepts to their clients. We'll be right back with Don Blanton on College Smart Radio.
For more information on today's topic, visit collegesmartradio.com or call area code 650-587-1559. College Smart Radio continues in moments on AM 1220 KDOW. Contact Beatrice Schultz at collegesmartradio.com or call area code 650-587-1559. Now, back to College Smart Radio with your host Beatrice Schultz on AM 1220 KDOW.
Welcome back to College Smart Radio, where we help you tackle the runaway costs of college. I'm Beatrice Schultz. I'm talking with my guest, Don Blanton, about the fundamentals of how a cash value life insurance policy works. We all know that college is expensive and will most likely be some of the most costly years for a family. Understanding how to navigate the college costs and save you where you can is an important and smart thing to know. To help families be on this radio show, I host community workshops via live and via webinar several times a month that explain the costs of various colleges, how the financial aid system works, and things to consider to prepare yourself for this tremendous expense. You can find my workshop schedule and register at collegesmartradio.com. Don, we were just talking about life insurance, and you were talking about the stability of insurance companies, I think. I wanted to ask you just to talk a little bit more about how the life policy's loan provision works and the benefits of borrowing from the life company versus a standard loan.
A lot of people would like to be in a position where they don't borrow, they just put money away. So let's talk about the 529 plans for just a second. They do a great thing. You get to put money in with after-tax dollars. The money grows tax-deferred, and it comes out tax-free if they go to college. And what if there was another benefit with a 529 that would allow you that, okay, you've filled the tank, so to speak, if you can have that picture in your mind. You've put money in this